Your savings account is keeping you poor. Here's what to do instead. You did the responsible thing. You started saving. Every month a little goes in. $100 here, $200 there. You watch the balance climb. You feel disciplined, financially mature, like you finally have it together. Then one day you open the app and do the math. $10,000 sitting in your savings account, earning 0.5% interest. After an entire year, 12 months of discipline, you made $50. Meanwhile, everywhere you turn, someone is talking about stocks, index funds, compound growth, passive income. And a quiet, uncomfortable question starts forming in the back of your mind. Am I doing this wrong? The answer is half right. Saving is essential. But saving alone has almost never built real wealth, and the math on why will make you rethink every dollar sitting in that account right now. Saving protects money, investing grows it. These are not the same job. Most people treat their savings account like the finish line. It is not. It is the starting block. Here is what the numbers actually look like over time. $10,000 in a savings account at 1% interest. After 1 year, $10,100. After 10 years, $11,046. After 20 years, $12,202. $10,000 invested in a broad market index fund at a 10% historical average. After 1 year, $11,000. After 10 years, $25,937. After 20 years, $67,275. Same starting amount, same 20 years. A $55,000 difference created entirely by where the money sat. And it accelerates. The longer the timeline, the wider the gap. By year 30, the savings account produces roughly $13,478. The index fund produces $174,494. At year 40, the savings account barely cracks $15,000. The index fund is approaching $453,000. The biggest wealth gap in personal finance is not between people who save and people who spend. It is between people who save and people who invest. But here is the uncomfortable part. Most people who understand this math intellectually still do not make the transition, and the reason is not numbers, it is psychology. Saving feels safe. Your balance does not fluctuate. It does not drop 8% on a bad Tuesday in October. You can see it, access it, trust it. Investing feels like risk. Markets move, headlines get dramatic, portfolios drop. And the emotional discomfort of watching a number go down is powerful enough to keep millions of people earning $50 a year on $10,000 when they could be building real wealth. The transition from saving to investing is not a math problem, it is a psychological one. And the way to solve a psychological problem is with a clear, structured process, not a pep talk. Here is that process. Step 1. Build a real emergency fund first, and do not touch it. Before a single dollar moves toward investing, you need 3 to 6 months of essential living expenses sitting in cash, not invested, not in a brokerage account, in a high-yield savings account or short-term treasury bills where it is liquid and stable. This is not optional. It is the foundation everything else sits on. Here is why it matters more than most people realize. The single biggest reason people panic sell investments is because they need the money for something else. A job loss hits, a medical bill arrives, a car dies. And suddenly, the money they plan to leave invested for 20 years needs to come out right now, often during a market downturn, locking in losses at the worst possible moment. An emergency fund is not just a financial buffer. It is the psychological protection that allows you to leave your investments alone when life gets difficult. Without it, every market drop becomes a potential crisis. With it, a market drop is just noise. The number: single person with stable income, 3 months of expenses. Single income household or variable income, 6 months. Multiple dependents or industry with high layoff risk, 6 months minimum. Once this fund exists and is fully funded, it does not move. It is not available for opportunities, upgrades, or investments. It is your financial immune system. Step 2. Separate your money into 2 completely different buckets. This single mental shift eliminates most of the anxiety people feel about investing. Bucket 1. Safety money. This is your emergency fund plus any cash you will need within the next 1 to 3 years, a home down payment, a planned expense, a known upcoming cost. This money does not get invested. Its job is to be there when you need it. Stability is the only performance metric that matters here. Bucket 2. Growth money. This is every dollar beyond the safety bucket that you do not need for at least 5 years. Its job is to grow. It is allowed to fluctuate. It is expected to fluctuate. The short-term movements are not a problem, they are part of the process. Most people feel anxious about investing because they have mentally merged these two buckets into one. When the market drops, it feels like all their money is at risk. When you separate them clearly, a market drop only affects the growth bucket, which has years to recover and typically does. The safety bucket gives you permission to leave the growth bucket alone. That permission is worth more than any investment strategy. Step 3. Start small. The habit matters more than the amount. One of the most common reasons people delay investing is believing they need a significant sum to start. You do not. Most major brokerage platforms, Fidelity, Schwab, Vanguard, Robinhood, allow you to begin with as little as $1 in fractional shares. There is no minimum that makes investing real. Any amount makes it real. The goal of starting small is not to generate meaningful returns immediately. The goal is to build the habit, the familiarity, and the emotional tolerance for watching numbers move. These are skills that take time to develop and cannot be developed theoretically. A person who invests $50 a month for 6 months and never panics has learned something that cannot be learned any other way. They have watched a balance fluctuate and survived it. They have built evidence that the volatility is manageable. That experience is worth more than any amount of research. Start with whatever amount feels almost too small. The habit of consistent investment is the asset. The dollar amount scales later. Step 4. Keep it simple. The most boring strategy usually wins. New investors consistently make the same mistake. They start with index funds, read about options trading or individual stock picking, and convince themselves that complexity equals sophistication. It does not. Decades of data consistently show the opposite. What a broad market index fund does, it holds hundreds or thousands of individual companies simultaneously, automatically adjusts as companies enter and leave the index, provides instant diversification across sectors and geographies, charges a fraction of a percent in annual fees, often 0.03% to 0.2%, and requires no research, no monitoring, no active decisions. What actively managed strategies typically produce? According to S&P Dow Jones Indices annual SPIVA report, approximately 90% of actively managed funds underperform their benchmark index over a 20-year period, with higher fees that compound against returns over time. And emotional decisions driven by short-term market movements. The person who invests $300 a month in a total market index fund and checks it quarterly will, in most historical scenarios, significantly outperform the person spending hours researching individual stocks or paying a fund manager to do the same. Legendary investor Warren Buffett has publicly and repeatedly recommended low-cost index funds for the majority of individual investors, including in his own will, where he instructs that 90% of the money left to his wife be invested in an S&P 500 index fund. The boring strategy works. The exciting strategies mostly transfer money from retail investors to professionals. Step 5. Let compounding work. Time is the variable nobody can buy back. Here is the math that changes how people think about time. Investing $300 a month at 8% average annual return. After 10 years, you contributed $36,000, portfolio value $55,000, gain from growth $19,000. After 20 years, you contributed $72,000, portfolio value $176,000, gain from growth $104,000. After 25 years, you contributed $90,000, portfolio value $285,000, gain from growth $195,000. After 30 years, You contributed $108,000, portfolio value $440,000, gain from growth $332,000. At 25 years, you contributed $90,000. The market contributed $195,000 on your behalf, more than twice what you put in. At 30 years, you put in $108,000. The market added $332,000. Your own contributions became the minority of your portfolio. That is not a projection or a sales pitch. That is compound interest operating at scale, and it requires only one thing from you: time in the market. The most destructive thing most investors do is interrupt this process by withdrawing during downturns, pausing contributions when markets fall, or waiting for a better time to start. Every year of delay at the beginning of an investment timeline costs significantly more than a year of delay later, because early dollars have the most doublings ahead of them. What about market crashes? This is the question almost every new investor asks, and the honest answer is not the reassuring one most finance content provides. Markets will crash. They have crashed approximately every 7 to 10 years throughout market history: 2000, 2008, 2020, 2022. Each time felt different. Each time the recovery came. The S&P 500 has never failed to recover to a new all-time high following a correction, though the timeline has varied significantly. Here is the counterintuitive reality that experienced investors understand. For someone in the accumulation phase, consistently investing monthly, a market crash is a discount. The same $300 monthly contribution buys more shares when prices are lower. When the market recovers, those cheaper shares appreciate from a lower base. Investors who continued contributing through the 2008 crash and through March 2020 saw disproportionately strong returns in the years that followed. The investors who got hurt were the ones who stopped contributing or sold during the downturn, converting a temporary paper loss into a permanent real loss. The protection against panic is not market prediction. It is having a full emergency fund, a clear investment horizon, and the mental framework to separate short-term noise from long-term trajectory. The 5-step path. Step 1. Build a 3 to 6 month emergency fund in cash. Do not invest this, do not touch it. Step 2. Separate your money into 2 buckets: safety money and growth money. Know which is which before anything else moves. Step 3. Start investing any amount consistently. The habit and the emotional tolerance are more valuable than the initial sum. Step 4. Keep it simple. A low-cost, broad market index fund outperforms the majority of active strategies over any 20-year period. Step 5. Stay invested. Give compounding the years it needs to work. Do not interrupt the process. The real gap. Saving gives you stability. A full emergency fund, a buffer against disruption, the ability to handle what life throws at you without going into debt. That is real and it matters. But stability is not the same as freedom. Freedom, the ability to stop trading time for money, to make decisions from a position of genuine choice, to reach a point where your portfolio generates more than your salary, comes from investing. From putting capital to work and giving it enough time to compound into something your savings account could never produce. The person with $10,000 in savings earning 0.5% and the person with $10,000 invested in an index fund start in the same place. 20 years later, they are in completely different financial realities, separated entirely by one decision they both had access to make. The earlier that decision gets made, the more time the math has to work. And the math, given enough time, works.